Hello, everyone, and welcome to our second session of the 2021 Government Services Seminar. First, let me introduce myself. My name is April Adams. I'm an assurance partner at Cherry Bekaert. I'll be hosting this session, and I'm happy to welcome Dan Goggerty, Audit Director with Cherry Bekaert, and Cherry Bekaert Senior Manager Tracy Bedgood. They will explore the effects of the pandemic on the state and local government and various relief efforts. Here's some quick housekeeping before we get started. First, if you have any questions during the webinar, please type them into the chat window located in your control panel. Our speakers will leave a few minutes at the end of their presentation to answer any questions. Next, we ask that you keep your microphone turned off for the duration of the session. And then this next one is very important. Please, to receive CPE credit, you must join this via the Zoom desktop application or the Zoom mobile app, not your web browser. So if you're currently using your web browser, please log out now and download the Zoom app by visiting Zoom US/download. CPE certificates will be issued via email within 10 days. If after 10 days you haven't received your CPE certificate, please email cbhlearning@cbh.com. A recorded version of this webinar will be made available in about a week, and it will be sent via email and posted to our website. And then please reach out to any of our professionals if you have any follow-up questions regarding today's topic or any other aspect of your business. We are here to help.
Good morning, everyone. It's great to be here to present to you, even though I'm not able to see you in person this year. Hopefully next year we'll be back into the normal swing of things. I did want to mention, Dan and I wanted to show our videos so that you would know who was speaking to you for this next hour. But in order to kind of circumvent any issues with network quality, we are going to stop sharing our videos during the course of the presentation. And I'll go ahead and do that now. And we'll go ahead and get started. I did want to thank April and welcome you all to our second session of the Government Services Group seminars. We are pleased to be here this morning to present some important and really relevant information on the newly released guidance under the American Rescue Plan. In addition, we will go through a little bit of updates, subsequent updates to previous legislation that were signed into law last year. So we have a lot of information to get to. So I'm going to go ahead and show you our learning objectives for today. These are our learning objectives. We will start off with a brief update on funding through the CARES Act and a summary of the legislation providing state and local government assistance to date. I will then outline some main features of the most recent American Rescue Plan Act of 2021 that are relevant to state and local governments. When I prepared this presentation and Dan was putting the information together as well, we were still awaiting some much needed guidance from the Treasury to be released, and we allotted the fourth learning objective on this page to kind of go through what guidance was released before this presentation date. While there is still a lot of information expected to be released in the coming days, I am pleased to report that some guidance was just released from the Treasury on Monday, May 10th. So we are able to incorporate that into this presentation as much as possible. I will try to include some key points as I go through the ARPA section of this presentation. And then after I'm done, I'll turn it over to Dan to discuss the emergency rental assistance program for the remainder of the session. Now, as April mentioned, but I'll mention it again, if there are any questions during the presentation, please feel free to type those in the chat box. We will do our best to monitor those questions and address them during the course of the presentation if time permits. However, if we don't have time to cover everything, we will certainly get back to you and provide an answer after the session. So before we get into a lot of the details, let's first start with our polling question number 1. And I'll have Maddie share that polling question with you. The first question is really just, we want to know who's in our audience today. So please just select the type of entity that applies to you. And if you're part of that other category, feel free to, add in the chat box what type of entity you're with, just to give us an idea of which of these items will pertain to you today. So responses to these polls are required for you to receive your CPE credit. So if you do want to obtain credit for today, please be sure to answer those polls. We'll leave it open for a few more seconds. It looks like 92% of you have voted. There's about 61%. The majority was city, county, and towns. We do have a handful of school system participants and authority board and commissions, and a few non-for-profits out there. So it'd be interesting to see what's in the other category. And we can end the poll now and share those results with you all. Okay, and we can stop sharing those results now. So, okay, so let's quickly discuss the CARES update. I know this has been a hot topic over the past year with probably everyone that's participating in attendance today. I know there's been a lot of ongoing discussion and interpretation, as well as we made our way through the coronavirus relief funds in particular, and the numerous frequently asked questions that were ongoing last year. I did just want to point out one update to the coronavirus relief funds, specifically through the CARES Act. You will recall that original eligibility requirements for CRF funds are shown here. As far as the period of time for the performance, those expenditures initially were required to be recorded or incurred between the period of March 1st, 2020 through the end December 30th of 2020. Then in December, the Treasury extended the deadline for expenditures to be incurred to December 31st, 2021. This was documented in the Federal Register that was released January 15th. And I'm sure you all are aware of this change, that you have a little more time to expend your CRF funds, but I did want to quickly mention it while we were on this topic. Next, I just wanted to quickly go over previous legislation. So far, there have really been 4 large main pieces of legislation passed in response to the COVID-19 pandemic that have a significant impact on state and local governments. We've had numerous webinars in 2020 on the first 3 that are listed here, but the most recent, the American Rescue Plan Act, was passed on March 11th, 2021. And the relief package provides funding in several areas, including state and local aid, education, rental assistance, transit. There's some stimulus payments for individuals and a host of other provisions. But really the focus of this presentation is going to be on the state and local government aspects of the legislation. Before we get into the details for the American Rescue Plan, I will post our next polling question. So as I just talked about the CARES Act funding and the extension of when those expenditures needed to be incurred, we will now ask you, have you spent all of your coronavirus or CARES Act funding as of today? Now I know that schools, you may have received additional or different funding through the Education Stabilization Fund or ESSER, rather than the coronavirus relief funds. But since the majority of you are cities, counties, and towns, I'd be interested to see if all of that money has been spent at this point, or if you still have some additional expenditures to make your way through for the next 6 months or through the end of the year. Does look like 86% of you have voted so far. 30% of you are saying, yes, you've spent all of your CARES Act funding as of today. 55% no, and Unfortunately, I guess there's 15% of you out there that did not receive any CARES Act funding. We'll give that just another second and share the results. All right. So as mentioned, the American Rescue Plan Act, or ARPA, as I'll refer to it throughout the presentation, that package does provide funding in several areas, such as state and local aid, education, rental assistance, just to name a few. This presentation does focus on the state and local government aspects. So I've listed on this slide several of the items that are included in the Act, and the bolded items that you will notice are the focus of this presentation, and we'll go into more detail about those. The other items are just kind of on here just for information. It's certainly not an all-inclusive list, but just wanted to give you an idea of some of the items that are included there. Since we don't go into much detail for the other items, I will quickly provide an overview of some of those. There are some great resources, for instance, a title by title summary of the Act that's available on the GFOA website, for example. There's a host of resources out there if you want to dive a little deeper into some of the other provisions contained in the Act. For the Child Care and Development Block Grant program, I just wanted to mention there's $15 billion in providing child care assistance for healthcare and other essential workers. The state must obligate these funds within fiscal year 21 and the following 2 years. So there will be additional funding to supplement other child care funding provided from other federal, state, or local resources, sources under previous legislation. The Low-Income Home Energy Assistance Program provides for $4.5 billion through September 30th of 2022. Utility assistance is also provided through $500 million for grants to state and local governments to assist low-income households that pay a high proportion of income for drinking water and wastewater. Those funds are to be provided to owners and operators of public water systems and treatment works to reduce arrearages and rates charged. Those funds are going to be available until expended and are to be allocated based on percentage of households in the state under the jurisdiction with incomes less than or equal to 150% of the federal poverty level and a percentage of households spending more than 30% of monthly income on housing. I did also want to mention that for our transportation agencies and airports, Section 3401 of ARPA does provide for $30.5 billion in assistance to public transit agencies, with funds available through September 30th of 2024. Expenses dating back to January 20th of 2020 are eligible and include payroll operating costs to maintain service due to lost revenue, as well as administrative leave. Of this overall allocation, there's $26.1 billion in the Federal Transit Administration's Urbanized Area Formula grants.
Hold on a sec.
Okay. Does someone have a question? Okay, I'll get started. As I was mentioning, of that overall allocation, the $26.1 billion is for the Federal Transit Administration through that urbanized area formula. And then $50 million is for grants to enhance mobility of seniors and individuals with disabilities specifically. Also $317 million for rural area formula grants, and $2 billion is also available for operating assistance for eligible entities for the costs related to operations, personnel, cleaning, sanitizing, transit systems, and even debt service payments incurred to maintain operations and avoid layoffs and furloughs. So there is a lot of additional assistance out there, and in addition, some capital investment grants of about $1.7 billion for our transit agencies. For airports, Section 7102 of ARPA does provide for $8 billion available through fiscal year 2024 through the Airport Improvement Program formulas, and that is at 100% federal share. Those funds do include $6.5 billion that's for primary and certain cargo airports, and then $100 million for general aviation and commercial service airports. They have earmarked a portion of that funding for primary airport sponsors to meet rent and other obligations for concessionaires included in the airport, and also to cover the full federal share of projects, including retroactively to some of those projects in fiscal year 20. So now I'll go on to the main topic of today's presentation with ARPA, which is the Coronavirus State and Local Fiscal Recovery Fund. We will start with some general overall information that was provided in the original act, and I will try to incorporate some of the recent guidance as we get into more of the details. Section 9901 of the Act does provide for $350 billion in additional funding for state and local governments. The state funding portion is approximately $195 billion, with $25.5 billion of those distributed to the states and DC. Now, the remaining amount that's distributed according to a formula based on unemployment, and the local funding portion is approximately $130 billion and is equally divided between cities and counties, about $65.1 billion each. So localities will receive funds in 2 tranches, with the first disbursement after certification, which began for some entities on May 11th, earlier this week. The second disbursement will be 1 year after that certification date. The funding must be incurred by the end of calendar year 2024. I did want to mention that there are some uses of the funds with the recent guidance that was released on Monday. There's a frequently asked question number 32 that indicates that for infrastructure projects, the Treasury interprets the requirement that costs be incurred by 12/31/24 to only require that recipients have obligated those funds by that date. So the guidance does provide that the period of performance will actually run through the end of 2026. This is to allow time to complete certain construction on infrastructure projects that are funded with this source. In addition, while the amounts allocated to cities and counties are equal in total, the allocation and distribution methods to cities and counties do vary based on CDBG entitlement and non-entitlement jurisdictions determination. So I will go into cities and counties in a little more detail separately. And you may be asking yourself, what does a non-entitlement mean? Typically, the general rule is that's going to be your cities and towns that have less than 50,000 population, and those are going to be treated a little differently than the entitlement areas. So for cities, $65 billion is divided between jurisdictions that are community development block grant entitlement jurisdictions and those that are not. There is $45.5 billion of that total amount that's allocated to metropolitan cities using a modified CDBG formula that is based on that. And then the remaining amount for jurisdictions that are non-entitlement CDBG areas will be allocated according to population. So for the non-entitlement jurisdictions, the amount also will not exceed 75% of the most recent budget as of January 27th, 2020. And additionally, non-entitlement jurisdictions proceeds will be allocated through the state for redistribution to local governments. I mentioned that some of the guidance was released earlier in the week, but really it only pertained to direct payments from the Treasury. The guidance for non-entitlement distributions and those to local, small local governments is intended to be made through the states, and that is expected to be released next week. So keep your eyes out for that and be sure to stay tuned to the Treasury website for availability of new information there. So for counties, the $65 billion will be allocated based on the county's population. Counties that are CDBG recipients will receive the larger of the population or the CDBG based formula calculation. So I am just curious if on the call, and maybe you can answer in the chat, are there any counties or larger metropolitan cities on the call that have been able to complete the certification process in the ID.me portal? I know I have heard over the last couple of days a few sources that the process does tend to be a bit cumbersome, and a lot of information is required from verification of the administrator that is certifying those funds. So I was just curious to see if those on the call were experiencing similar issues.
And Tracy, in the chat, it seems like quite a few are answering yes. So
okay. So I think that's a common thing. And as I mentioned, you know, there's still more information to come for those non-entitlement entities to be able to certify for theirs. So more to come in the coming days, but hopefully we'll get through this. So recipients, now we're going to talk about the eligible uses a bit. Recipients may use these fiscal recovery funds to do a multitude of things. They're very expansive. So they're able to support public health expenditures by funding COVID-19 mitigation efforts, medical expenses, behavioral health care, and certain public health and safety staff. They will also be able to address negative economic impacts caused by the public health emergency, including economic harms to workers, households, small businesses, and impacted industries, and even the public sector. There is an eligible use for replacement of lost public sector revenue, and I'll go into that in a little bit more detail. This funding will be to provide government services to the extent of the reduction in revenue experienced due to the pandemic. And also, you're able to use these funds to provide premium pay for essential workers, offering additional support to those who have the greatest health risk because of the service and critical infrastructure sectors. And then lastly, the eligible use of and being able to invest in water, sewer, and broadband infrastructure, making necessary investments to improve the access to clean drinking water, vital wastewater and stormwater infrastructure, and to expand access to the broadband internet. Within these several categories, the Treasury's interim final rule that was released on Monday does provide guidance and principles for determining the types of programs and services that this funding can support. So that, together with examples of allowable uses that the recipients may consider. So you will see a lot of examples in that guidance that you can find on the Treasury's website. I will just mention a few key items that have come to my attention that I think warrant a little more discussion. In general, I think it is important to note that the CARES Act coronavirus relief funds was more to address current needs from the pandemic, and the ARPA focus for these fiscal recovery funds is really more for the long term in nature and more forward focused for moving forward in the years to come through 2024. Regarding revenue replacement, recipients may use funds to replace lost revenue. So the interim final rule establishes a methodology that the recipient can use to calculate that reduction. Specifically, recipients will compute the extent of their reduction in revenue by comparing actual revenue to an alternative representing what could have been expected to occur in the absence of the pandemic. So analysis of this expected trend begins with the last full fiscal year prior to the public health emergency, and it projects it forward at either the recipient's average annual growth rate over the 3 fiscal years prior to the pandemic, or a de minimis rate of 4.1% that was calculated by the Treasury by looking at the national average state and local revenue growth rates from 15 through 18. Now, for administrative convenience, the Treasury's interim final rule does allow recipients to presume that any de minimis and actual revenue related to the expected trend is due to the COVID-19 public health emergency. So upon receiving the fiscal recovery funds, recipients can immediately calculate that reduction in revenue that occurred in 2020 and deploy funds to address any shortfall. Recipients will have the opportunity to recalculate revenue loss at several points throughout the program, supporting those entities that experienced a lagged impact on crisis on revenues. And I just wanted to note one thing that really stuck out to me, as I noticed in the frequently asked questions number 19 and 20, those relate to the revenue loss calculation. So number 19 indicates that a calendar year end will be used as the base years in the calculation. Now, to me, this seemed like this may pose a problem for some localities with June or even September year ends. Information may be a little harder to gather than just looking at your financial statements for that information. The calculation either takes the calculated growth rate based on an average of 3 calendar years prior to the pandemic, or that nationally computed average de minimis rate of 4.1%. So the calculated revenue of the growth rate versus the actual calendar year 2020 revenue will be the amount allowed for the lost revenue. So I just wanted to note that. Also, since the funds for the lost revenue replacement have to support government services and citizens specifically, recipients are not allowed to use the revenue replacement funds for a rainy day fund expenditure or for interest or principal payments on debt service.
Hey, Tracy, we've got a question in the chat about using it for premium pay. And the chat talks about how maybe there's a limitation per person for premium pay, and was curious if that limitation includes benefits for that person.
So there are some restrictions on premium pay. I was trying to pull up my actual frequently asked questions because there are a lot of examples actually with that. If you could give me a minute after this presentation, I can respond to that directly through the chat once I pull up my other resources on my screen.
Okay.
But yeah.
And then there's one more question that just popped up, wondering, do we know if there's any exceptions for the revenue replacement calculation to aggregate all the revenues?
Yes, so there are some items that it's looking like will not be able to be included in that calculation, and that interim final rule and the frequently asked questions does provide a lot more guidance on that. But you will, there are certain utility revenues that are not allowed to be included. That's just one off the top of my head. But I can certainly share that information with everyone, and a link to that in the chat as well.
Thanks, Tracy.
I'm running out of, I'm worried that I'm not going to give Dan enough time. So I will cover that in the chat if you'll just remind me of those questions. So, so I just wanted to quickly move on to the restrictions on use. We did briefly talk about the eligible uses. To ensure that these funds are used for the intended purpose, the American Rescue Plan Act really just specifies 2 main ineligible uses of these funds. So for states and territories, you can't use funding to directly or indirectly offset a reduction in net tax revenue due to a change in law from March 3rd, 2021 through the last day of the fiscal year in which the funds were provided have been spent. It does make sure that the Treasury's interim final rule does implement that requirement. And if the state or territory cuts taxes, they must demonstrate that they paid for the tax cut from sources other than these fiscal recovery funds. So they had to have enacted policies to raise other sources of revenue, cut spending, or have higher revenue due to economic growth. The funds provided that have been used to offset the tax cuts, the amount used for that purpose would have to be paid back to the Treasury if you were using this funding just so that you could have a tax decrease or tax cut. Secondly, the recipient may use, I'm sorry, was someone asking a question? Okay, so the second main use is that no recipient may use the funding to make a deposit to the pension fund. The interim final rule does define a deposit as an extraordinary contribution to a pension fund for the purpose of reducing an accrued unfunded liability. While pension deposits are prohibited, recipients may use the funds for routine payroll contributions for employees whose wages and salaries are for eligible use of funds. The Treasury's interim rule does identify several other ineligible uses that I mentioned previously, including funding debt service, legal settlements or judgments, and deposits to rainy day funds or financial reserves. So also, just lastly, the general infrastructure spending is not covered as an eligible use outside of water, sewer, and broadband investments specifically. While the program offers the broad flexibility to recipients to address local conditions, these restrictions are intended to ensure that funds are not used to augment existing activities and address needs that otherwise would not have. So I did want to talk briefly about the Elementary and Secondary School Education Relief Fund. This also is provided under the American Rescue Plan. Schools will have seen another form of this same funding through the CARES Act previously. I think this is probably the third round of elementary and secondary school education relief funds that you've seen. It is approximately $122 billion that's provided to states and school districts to help safely reopen schools and to sustain safe operation of schools in the pandemic. Now, a state must subgrant at least 90% of those funds to local education agencies, and it's to meet a wide variety range of needs arising from the pandemic. Now, like I mentioned, it can include reopening schools safely, sustaining operation, also addressing students' social, emotional, mental health, and academic needs resulting from the pandemic. And the state must allocate those funds to the LEAs based on their respective shares of funds received under Title I. Now, this is similar to the prior funding through CARES and the way that it's being allocated. Let's see. This fund does include 3 state level reservations for activities and interventions that respond to those academic, social, and emotional needs that I mentioned. So it's basically, there's a portion that's being allocated to low income families, children with disabilities, English learners, gender, students experiencing homelessness, and a number of other items to address the needs of children specifically. Now, of the total amount allocated to LEAs for the state award, the LEA must reserve at least 20% of those funds to address learning loss through the implementation of evidence-based interventions and ensure that those interventions respond to the student's social, emotional, and academic needs. And it's not disproportionately, and it addresses those that were disproportionately impacted on COVID-19. Now, the remaining LEA funds may be used for a wide range of activities that address the coronavirus, but like I said, the first 20%, at least that 20%, must be targeted to disproportionately impacted individuals or students. It was back in April, there was some additional guidance that was released related to the education or the elementary and secondary school education relief fund. So there is more information out there. I had planned to go into a little more detail, but I do want to allow Dan a little bit of time on the ERPA. Also, just lastly, before I go, I did want to briefly discuss the paid sick leave credit. You may remember under the Families First Coronavirus Response Act that there was local governments were included in that mandated requirement of providing paid sick leave to their employees. Originally under the Family First Coronavirus Response Act, local governments were not available, were not able to get a credit for those amounts. Now under ARPA, the act is providing an extension and expansion of those paid sick leave tax credits, and it does include some local governments now. That does cover the paid leave through the end of September 21. So I did want to just briefly mention that's something that wasn't available previously. I do want to allow enough time for Dan's portion of the presentation, but before I turn it over, I just wanted to do the third polling question. So here we're asking, what type of eligible expenditures are you planning on using your American Rescue Plan fiscal recovery funds for? And, or what do you think the best use of that money would be? We'll give everyone just a few moments to respond. Looks like 85% have voted so far. 26% of you are saying revenue replacement. 39% is for COVID-19 impact grants. A handful of you, 8%, are indicating premium pay for essential workers, and 26% for investments in water, sewer, and broadband infrastructure. So it's pretty evenly across the board. And we shared those results. And Dan, I'll now turn it over to you.
Thanks, Tracy, and good morning, everyone. As April mentioned earlier on, I'm a director out of our Charlotte office, and I'm going to go over real quick here about the Emergency Rental Assistance Program, which is another part of the whole American Rescue Plan that Tracy just spoke about. In this, it is going to be a little bit more limited to those that have populations in excess of 200,000. So those less than 200,000 will not receive this funding directly, although you may receive this funding as in the form of as a subrecipient from one of those cities or counties that have in excess of 200,000 population. And one thing I do want to mention before I get into the next slide is I'm going to distinguish between ERA 1 and ERA 2, standing for Emergency Rental Assistance 1 and 2. On May 7th, the Treasury had issued some guidance regarding the first round of funding that was made available and the second round of funding that was made available. And there are some certain nuances between the two. They're fairly the same, but there's definitely less paperwork and less requirements under the ERA 2. But going into the next slide here, I'm just going to talk about the different types of eligibility that we have here. So we have, if Tracy, could you just go to the next slide? We'll have eligible households defined as a renter household in which at least one or more individuals meets the following 3 criteria. And so the first is to qualify for unemployment or has experienced a reduction in household income, incurred significant costs, or experience a financial hardship due to COVID 19. From the unemployment standpoint, for both the ERA 1 and 2, a written attestation or other relevant documentation regarding unemployment is an acceptable way of determining this is eligibility has been met. And really, I'm going to go into another slide. It really comes up to the organizations to really have a process and documentations written that clearly state what you are going to do in terms of, like in that instance, other relevant documentation. What are you going to consider other relevant documentation that would be considered possible? And then from the next part, we demonstrate the risk of experiencing homelessness or housing instability. And so we'll go into that in a future slide here. And then the last one is, and has a household income at or below 80% of the area median income. And so there's ways to determine this. And so if you determine it through a written attestation, that is good for the whole period in which you're determining them to be eligible. If you get it through a written attestation, then there's no further documentation to support their income, then you are going to have to do that every 3 months. If you can get actual support for their income and make sure that it's under the threshold, and verify that with third-party information, which again, I'll go into another slide here on what kind of information that would be, then you can do that over the whole 12 and plus 3 month period of time without having to reassess every 3 months. One thing that just from the ERA 1 and ERA 2, one says for the first requirement that COVID-19 outbreak, the other says coronavirus pandemic. In its eligibility requirements, the Treasury has considered both to have the same meaning. So while you see two different items being mentioned there, you can consider it really the same eligibility determination. And then also with the household income verification, similar requirements between the two, but revised third-party eligibility requirement to be part of Section 3B of the United States Housing Act, rather than just calling out the household income at or below 80%. Allows for a little bit more flexibility in the use of the ERA 2 funding. But again, if you want to determine them to be eligible under either ERA 1 or ERA 2 from a household income verification based on the ERA 1 guidance, you don't need to worry about the ERA 2 thing, because obviously ERA 1 is going to be more stringent. And so in the next slide here, we're going to go into the homelessness piece, which is the second one on that last slide we talked about. And like I mentioned, you can make your own criteria, but this must be documented in your policies and procedures. The Act requires for one or more individuals within the household that can demonstrate a risk of experiencing homelessness. And some of the examples that they gave to be able to determine this was a past due utility or rent notice or eviction notice, unsafe or unhealthy living conditions. And then they give the kind of the catch-all, any other evidence of risk as determined by a grantee. Again, it's just going to be important here that you really identify what you consider to be risk of homelessness or risk of housing instability, and then just make sure you're following that whatever you have determined consistently across all applicants. In the next slide here, we're going to go over here is the household income definition. So with respect to each household applying for assistance, grantees may choose between using HUD's definition of annual income and using adjusted gross income as defined for purposes of reporting under the revenue form 1040. So basically your adjusted gross income that you would report on your 1040 would be the income reportable. And the Act provides that grantees may determine the eligibility through the household's total income for the calendar year 2020, or sufficient confirmation of household monthly income at the time of the application. This may include getting certifications from an employer, getting pay stubs, getting bank statements that show what the income is during the year. There also is in the facts an item known as fact-specific proxy. So a grantee may rely on a written attestation from the applicant regarding household income, and if the grantee also uses any reasonable fact-specific proxy for the household income. And what that means is reliance on data regarding average incomes in the household's geographic area. So where that household, where they reside, looking up data in terms of the average income in that area and making sure that what they're giving on their certification makes sense based on that average area. And if income is not verifiable, as I said, or by proxy or other means, this must be reassessed every 3 months. And so you can't do a one-time eligibility determination with those situations. So the next slide, I'm going to talk about the Emergency Rent Assistance Program application process. And so in the application process, grantees must have reasonable basis under the circumstances for determining what the income is. And as I mentioned just on the last slide, some of these examples may be pay stubs, W-2s, tax filings, bank statements, or other attestations from an employer. Without further documentation, as I mentioned, you have to reassess every 3 months or so. And so we'll go on to the next slide here is we're going to talk about the application process. So an application for rent assistance may be submitted by either an eligible household or by the landlord on behalf of an eligible household. So households and landlords must apply through programs established by grantees, and in general funds will be paid directly to landlords or utility services. But if the landlord does not wish to participate, funds may be paid directly to an eligible household. And some of those outreach have been outlined in the facts. They talk about requesting for participation is sent in writing by mail to the landlord or utility provider, and the addressee does not respond to the request within 14 calendar days after the mailing. If the grantee has made at least 3 attempts by phone, text, or email over a 10 calendar day period to request the landlord to participate, or a landlord confirms in writing that the landlord does not wish to participate, the final outreach attempt or notice or to the landlord must be documented. And one point here also is that the cost that you incur in contacting the landlord to determine this to meet the standard of the outreach is determined to be an eligible administrative cost. I will point out here on ERA 2, for the second round of funding, there is no similar requirement for outreach to landlords. So they made it a little easier for the second round of funding. So you really are going to want to pay attention to what funding you are using, whether it's ERA 1 or ERA 2, because as an auditor, when we come in and look at those records and make sure you're following the compliance requirements, if this is one of those main items that we will be testing, we will be looking to see if it's ERA 1 that you did the outreach, ERA 2, we will not be looking at that at all. And then ERA 1 provides an option for tenants to apply directly. On ERA 2, grantees are required to allow tenants to apply directly. And so on this slide here, this is what I talked about earlier. It's really important that from a policies and procedures standpoint, that you really document well what your policy is regarding this, and then the controls in place ensure compliance and policy procedures to prevent fraud as well needs to be addressed in those procedures. Going to the next slide, we have additional eligibility requirements. Rental assistance provided to eligible households should not be duplicative in nature. I will say for the ERA 1, this is very specific, but they do mention in the facts that doesn't mean that you can't provide funding to those that are in federally subsidized properties or receive other kind of housing vouchers from federal or state funds. They are eligible to receive assistance, just cannot be duplicative between paying them for both. With respect to our ERA 2 grantees, you must not refuse to provide assistance to such properties. They explicitly say that in there, but in both cases, you really need to be considering them to be eligible as well. And then also with ERA 2, there are no similar requirements on the duplicative assistance, but they do say the Treasury is encouraging to maximize the program, that you minimize providing similar assistance on something that already has received the assistance. And one thing to note here as well is that you must by July 15, 2021, publicly post, whether on a website or through a newspaper or other means, how you're going to implement the second bullet point down here, which is prioritization of those that receive income at or below 50% of the area median and has been unemployed for 90 days prior to the application for assistance. Going one more slide here. These are just, I'm going to go really quick over this. You should be able to get a download of this information, and this all is shown in the facts. These are just a minimum what grantees should anticipate in collecting for households and retaining. And going to that next slide, we talked a lot about eligibility here. I had a lot more to go over with what eligible costs, but I'll go really high level. Rent in arrears and rent prospectively is allowable, just not before March 13, 2020 for rent in arrears. And you can do it prospectively and not, if someone is not in arrears, doesn't mean they're not going to meet the standard to be eligible. They still can be eligible. Utilities is another way to cover electricity, gas, water, sewer, trash removal, energy costs, fuel, oil. Other expenses related to COVID-19 for ERA 1, and then other expenses for ERA 2 can be unrelated to COVID-19, but need to be related to housing needs in general. And then one other thing I'll point out is that you mentioned the Low Income Housing Energy Assistance Program is a federal program that you're going to receive additional money through the ARPA as well. So you may want to work in conjunction with that program when implementing this emergency rental assistance program, as that program really covers for a certain period of time during the year energy costs. And so making sure you're maximizing the use of the program, as this one, as the Low Income Housing Energy Assistance Program wouldn't be allowed for rent, but this program would. And in the facts, there's a list of ones I was going to mention here, but I'll save it for the time being. But other expenses that can be used, which include hotel expenses in certain situations. So be cognizant of that. In terms of the limit of ERA 1 and 2, we have 12 months plus additional 3 months. And the ERA 2 is an 18-month aggregate with including the ERA 1. So if you have someone who started with ERA 1, they can go 12 months plus an additional 3 months if they're still determined eligible. So that's 15 months, and then an additional 3 months with the ERA 2, so 18 months in aggregate. And the last thing here is administrative funds, 10% for ERA 1, 15% for ERA 2. And it says on the last slide, expires in 2022, I think, or 2024. ERA 2022, the ERA 2 funds go till 2025. So while ERA 1 is 2022, ERA 2 is 2025. And here are some links that you can use as well. They're all still included in the facts. So let's just bring up the polling question. Do you have a process and control documents in place already related to the ERAP? Got about 50% so far. We got about 42% say yes, 18% say no. We got about 40% online that did not receive it. Again, if you did not receive ERAP funding, you may still receive it in the form of a subrecipient agreement. So be on the lookout for that as people start to get through this program and start to actually administer it. And we're about 86% now and still about the same results as before. We'll just give a few more minutes to make sure everyone can answer this one. We're staying right now at about 86%. Please put your votes in to make sure you get accounted for your CBE. All right, I think we're going to close the poll here and share the results. As you can see here, about 39% yes, 21% no, and then 40% about that said no, that they didn't receive it. So just want to thank everyone for attending the session. I know we went a little bit over here. Hopefully you'll have a little time for a little break before your next session. And we enjoyed being able to speak with you about this. So please feel free to ask any questions in the chat bot, and we'll try to get with you at a later date and email you personally if we haven't been able to answer your questions already. Thank you.
All right, so that concludes our second seminar session. Thank you again for joining us. If you have any additional questions regarding today's or any other topic, please feel free to reach out to Daniel, or Tracy at any time. They will be responding to the questions in the chat pot to get back to you guys. We'd value your feedback, so that we ask that you take part of the survey that's just been posted in the chat. And our next webinar, Top 5 IT Hot Topics, will begin at 11 a.m. in just a few minutes. So we hope to see you in that session as well. Thank you.